Hey everybody, welcome to the Blockworks Macro channel. This is Alf speaking. You know me by now. And today's guest is the great Maroon Macro. He's the author of Monetary Mechanics, a fantastic newsletter on the monetary mechanics. You can find him on Substack. You can find him on Twitter. I read him every freaking week, so you should do the same. How are you doing, Maroon?
I'm fantastic. How about you, Alf?
It's all good. I'm so happy to have you here. As everybody knows, I guess, but it's good to repeat it. This is an educational series I'm doing for Blockworks Macro. So today we're going to talk about money. What is money? The different forms of money, the interaction between those. If you like this kind of conversation, just subscribe to the Blockworks Macro channel. You're going to hear a bunch of those. But let's get into it now. So I think the question where I want to start is very basic, which is what is money? I mean, are there different forms of money out there? People always talk about bank reserves, and then there are this bank deposit, and then there's physical cash. Can you help us understand, if there are different tiers and why is that the case, and do they interact with each other?
Yeah, sure. So I guess, there's, as you sort of alluded to before, there are various sort of levels of money, if you will. And so I guess the two most important, kinds of money that people will be very familiar with are bank reserves and deposits, basically, are probably the two most kinds of money that people hear about all the time. And so basically bank reserves are essentially money for banks. And bank reserves are important because they're a direct liability of the Federal Reserve, which means that, they have no duration and there's no credit risk. And bank deposits, on the other hand, while they do have FDIC insurance, are still a liability of a commercial bank as opposed to a liability of the Federal Reserve. And so what that means is that technically, bank deposits do have some type of minute amount of credit risk, especially, if you have, bank deposits in excess of $250,000 or whatever the FDIC limit is. So bank deposits and reserves are the, two primary forms of money. And then there's also a third form of money that, is still important, but is, sort of less relevant to the real economy with, each passing year. And that's physical currency or also known as cash. So physical currency is important because it is also a direct liability of the Federal Reserve. And importantly, it's the only way that everyday businesses and citizens can have access to some sort of direct liability of the Federal Reserve to use in their own economic transactions. And so that's what makes physical currency fundamentally different than bank deposits. Because when you're transferring or like wiring money, say when you're paying for something using a debit card, you're paying in bank deposits. You're not paying in something that is a direct liability of the Federal Reserve. You're paying in something that Citibank may owe to you. But if you're paying in physical cash, then that's a credit risk-free transaction. And this is very important because it refers to, as it pertains to, the nature of the transaction. Because there are certain things which are considered final settlements. So something is considered final settlement if J.P. Morgan wires Citibank reserves over FedWire. That transaction is considered final. But if you wire, bank deposits to me, that transaction is not necessarily considered final until these reserves are wired from one bank to another. Even though the deposits may show up in my account, it takes a few days for that transaction to confirm. So I guess to summarize, at a high level, there's three different kinds of money. There are bank reserves, there are bank deposits, and then there are physical currency. Bank reserves and physical currency are liabilities of the Federal Reserve, and bank deposits are liabilities of commercial banks. And so I guess if you take a look at this diagram, the hierarchy of money in the real economy, you can see like all these, different types of money laid out very neatly, and just sort of see like how these different tiers of money like can interact with each other in different ways.
No, okay. So you unpacked quite a lot for us. I want to make sure that we again go one by one these important topics. The first is, okay, basically you said that there is a money for banks and there is a money for the real economy at the end of the day, right? And so the money for the banks is bank reserves, and the money for the real economy is mostly bank deposit and some cash, because you said it's becoming less and less used. So the first question I have is, can you give us some percentages of how many transactions roughly today are represented in bank deposits and how many are in cash in any developed economy, if you have any statistics?
If I can remember correctly, like something about maybe 10% of The total the amount of like total like M2 like bank deposits in circulation. I think there's roughly 10% of that amount in physical cash. So I think it's like $1 or $2 trillion of physical cash and something like close to like 20 or 22 trillion in bank deposits. Don't quote me on that. I think it's like rough numbers, but then the actual percentage of transactions on that is much smaller. So if I had to guess, maybe 1% or 2%, if that, of all transactions in the economy are done with physical cash today.
So in Europe, the European Central Bank estimated about 2.5 to 3% of the transactions are done in cash. So here you go. And we have some countries like Germany or Italy to a certain extent in Europe that are very cash intensive when it comes to transactions. I think in the US it's probably even smaller than that. You're right, I guess. Now the most interesting part is, okay, so bank reserves and let's say bank deposits, they represent most of the real economy cash money anyway. People, I think, are mostly interested in what creates inflation. And normally they are bound to think that it's an increasing amount of money, spendable real economy money, against a relatively sticky amount of goods that must increase prices at the end of the day. So the obvious question I have is, can you turn one form of money into another? And who actually prints these bank reserves? Most importantly, who prints these bank deposits? Who creates new bank deposits?
Basically what happens is if banks have reserve balances at a Federal Reserve Bank, what they can do is they can go to the Federal Reserve and they can ask to be credited in physical cash for their reserve balances. And so what they would do is that they would talk to maybe the Federal Reserve Bank of New York, and they would ask for some additional physical cash, and the Federal Reserve Bank of New York would literally send like an armored car over with guards and everything, and they would go take that cash over to the vault of J.P. Morgan, for example. So reserve balances and physical cash in that sense are interchangeable. Bank deposits are not. They are created by commercial banks when they make loans, and so that is the way that bank deposits are created. They are a claim against the assets of a commercial bank. And so bank deposits in that sense are fundamentally different than physical cash or reserve balances at a Federal Reserve Bank.
So wait a second, you're telling me that 97% of the transaction happen in bank deposits, and who creates bank deposits, so basically the money that we use in the real economy, is not the Fed, but is actually commercial banks. Is that what you just told me?
That's absolutely correct.
Okay, that's cool. So apparently, who prints the increasing amount of money that can generate this mismatch between spendable money and a basket of goods in the CPI is commercial banks, not the Fed. But wait a second, I also thought that banks lend reserves out. So if the Federal Reserve gives you an increasing amount of bank reserves by doing QE, for example, and we can talk about how that works, then banks can just turn some of these reserves into cash. That's what you just said. Or they can even lend out reserves. That's what I heard. Do you want to elaborate on that?
Yeah, so banks can lend reserves, but they can only lend reserves to each other. Most importantly, reserves cannot be lent to businesses or individuals. And that's because businesses and individuals don't have a master account at the Fed. And so what's required in order to be able to pay in reserves is a special kind of bank account with the Fed called a master account. And only certain kinds of entities have those accounts. So it's like something like regulated depository institutions. So like your banks, also like the U.S. Treasury has one called the Treasury General Accounts. Some of the federal home loan banks and other types of government institutions also have master accounts with the Fed. But the important thing is that individuals like consumers and businesses do not have master accounts with the Fed. So nobody can lend reserves to them because you don't have an account. So banks can lend reserves to each other, but they cannot lend reserves to businesses or consumers.
So these reserves are basically stuck in the system, in the banking system, you're telling me, unless all of us go straight away at all the ATMs out there and demand to withdraw physical cash at the same time. That must be the way that you are able to release reserves into the system, and it makes more spendable money available, which means reserves are ultimately inflationary if everybody withdraws their cash, or not.
In theory, like if you really wanted to do that, then I guess it would be possible, yes. But like as we mentioned, just because of the nature of the economy and the fact that 98 to 99% of or 97 to 99% of transactions are not made using physical currency, it's functionally sort of irrelevant as it pertains to sort of like inflation or any real type of economic activity. It's such a small percentage that I think that the fact that reserve balances can be converted into physical cash and vice versa, I think it is basically irrelevant as it pertains to, the potential of bank reserves to be inflationary.
And now, Maroon, the other thing that I thought is the quantity of spendable money in the economy needs to increase. And if you withdraw cash, you are lowering your bank deposit and you're increasing your cash stack. You're basically swapping the form of money you own from 100 bank deposits and 0 cash to, let's say, 50 bank deposit and 50 cash. If you want to withdraw half of it in cash, the total is still 100 at any point in time. So you, as the user of this currency that is supposed to have inflationary effects, you still have $100 overall. You just change the format from bank deposits into cash and vice versa. So even if all of us would convert into cash, then yeah, we would have more bills than bank deposits, but ultimately the total amount of spendable money isn't changed by this operation.
Yeah, that's exactly correct. And so, as soon as you spend, those bills, they would likely be turned back into bank deposits at some other bank. And so it sort of just shifts around, but it doesn't really change the that total aggregate quantity.
But now, reserves are what people focus a lot on because they are the liability side of the Federal Reserve balance sheet. As you just said, they're a liability for the Fed. And every time the Federal Reserve goes with quantitative easing, the Federal Reserve balance sheet increases. So I have two questions for you. The first is, can you simply explain what the Fed does from a balance sheet perspective when they do QE? And then the second question linked to that is, the banking system gets flooded with these reserves, as we discussed, which are money for banks. What are banks doing with these bank reserves in the first place anyway?
Yeah, so I guess with quantitative easing, it gets a little bit nuanced and a little bit complicated depending on sort of what scenario you're talking about here. But broadly speaking, there's sort of a couple different, major outcomes from quantitative easing. One is if the Federal Reserve does quantitative easing with the banking system, or the banking system is the end purchaser of whatever, the end seller of whatever security the Fed is purchasing, then all that happens is there's literally no change in the total assets of the banking system. It's just a direct swap treasuries for reserves. And so the banking system would have less treasuries and more reserves. And that's it. Nobody else's balance sheet changes. If, however, there's an institutional investor who is the ultimate seller of these treasury securities to the Fed during quantitative easing, then what would happen is that because, like I mentioned earlier, institutional investors do not have master accounts with the Fed, they cannot hold reserves. So what would happen is the Federal Reserve would credit the institutional investor's bank with reserves. And then that bank would then create deposit liabilities to issue that institutional investor on their behalf. And so the institutional investor would have extra deposits. The banking system would have more reserves and more deposits and less treasuries. And the Federal Reserve would have more reserves and more treasuries.
Okay, now, which means that if the Fed does QE not with a bank, where it's simply an asset swap between treasury and reserves, but it does it with a pension fund, then it takes the bonds away from the pension fund, and the pension fund doesn't have a master account at the Fed to have reserves. So what they will have is bank deposits. They will have more money placed at JP Morgan than they had before, because their bonds have been taken away. Okay, so it's more bank deposits. And you just told me, Maroon, before, the bank deposits are the way that real economy money is actually created today. So it must mean that the higher bank deposits owned by an asset manager or pension fund are inflationary. So QE is inflationary.
Well, it's sort of, it depends, right? It depends on, just the aggregate quantity is important, but also how those deposits are used is I would say even more important. So if a pension fund, has excess deposits in their investment portfolio, what is that pension fund likely to do? They're likely to spend it on other kinds of financial assets, either like buying more U.S. treasuries, buying corporate credit, buying equities, something like that. So that's where those deposits can go. Or, one way, deposits can technically leak into the real economy through this is through the direct lending and direct investment portfolios of institutional investors. And so, sort of as these investors have been pushed out further on the risk curve, over the past decade or so, these investors have been sort of more active in things like private equity or direct lending. And so technically there is a little bit of leakage of bank deposits that can, trickle out from the direct lending portfolios of these institutional investors into the real economy. But, and don't have the numbers off the top of my head again, but I think if I can recall correctly, that the direct lending industry for institutional investors is relatively small, just on the order of like a few $100 billion. So in terms of like compared to the aggregate scale of quantitative easing and the total amount of bank deposits available in the real economy, it's really just a drop in the bucket. I guess, technically speaking, some of those QE created bank deposits can leak into the real economy, but I would not necessarily say that it's a significant contributor to inflation.
So the forest for the tree here, in order for us not to miss that, is that the spendable, potentially inflationary amount of bank deposit get increased mostly by commercial banks when they lend, because they create new deposit to a private sector that has volunteered to borrow in most cases, which means it has increased the amount of bank deposits I can spend, you can spend. While if we do this whole circle with QE buying from a pension fund, that increases the pension fund bank deposits that are much less likely and in much lower proportion to turn out supporting basically the price of a basket of goods in the CPI basket. That is what people are interested in, right? To see whether this has inflationary impacts or not.
Yeah, basically, a pension fund's not going to be buying, televisions for those bank deposits. Is sort of what it comes down to at the end of the day.
Pretty much. Okay, now, so it's important to track the amount of bank deposits that are in the non-financial sector, let's say. So you can say that, if a corporate is owning bank deposits or a consumer is owning more bank deposits, there is a chance that these bank deposits will get into the real economy, into basket of goods, and that is inflationary. The bank deposits owned by financial institutions are less likely to be so. But you still haven't answered the fun question I asked you before, which is, banks with QE get, in a way or another, they still get more reserves. They can't get around it. They're forced to have more bank reserves. What the heck do they do with these bank reserves?
Yeah, so before the financial crisis, banks used to lend reserves to each other in the federal funds market. Now that's it's relatively deprecated, so the federal funds market is not such an active market anymore. But banks still need reserves, to lend into the repo market. They also use reserves to lend into the FX swap market, and they use reserves to settle transactions between each other as well. So and I guess a very, very important thing also, so with sort of Basel III and Dodd-Frank is that, banks need bank reserves to be able to satisfy Basel III's LCR ratios and Dodd-Frank's resolution planning and intraday liquidity requirements as well.
Okay, so all the very fun stuff of high quality liquid assets, liquidity coverage ratios, all that boring stuff that is regulatory driven, and I was doing until a few months ago, yes, I can confirm bank reserves are actually serving that function. The most interesting function you said before, though, is that bank reserves can be used to settle payments within banks. So a more direct question for you is, if after QE, JP Morgan finds themselves with more bank reserves, and they want to replenish their treasury portfolio. So they were taking away some treasuries, they now have bank reserves. Instead, they want to go and rebuy these treasuries that have been taken off from the Federal Reserve because of QE. And they go and want to buy those from Citigroup, basically. Can they use reserves to buy these treasuries or not?
Yeah, that's what they use, is banks that they use reserves to buy things from each other, basically.
So effectively, these reserves ultimately can be used in a portfolio rebalancing effect when banks buy from each other to sort of chase risk assets. I mean, you start from bonds, then you move to credits, maybe safe corporate bonds and other assets. Can you make an argument by saying that an increasing amount of bank reserves in the system ultimately leads to a portfolio rebalancing effect or not?
Yeah, I think that's generally speaking one of the ways that quantitative easing is understood to work, is essentially through this portfolio rebalancing effect.
Yeah. So for people, it is interesting to understand that while we basically discussed that there is no way that bank reserves can get into the real economy, they can be turned into cash, but again, they won't increase the spendable amount of money in the real economy. They will just swap the form of money held by the private sector. It is important to know that these bank reserves, if thrown in big size into the banking system, they can lead to a portfolio rebalancing effect. And so, Maroon, my question is, how relevant do you think that is? I mean, is that really a measurable thing? And have you done some work on it? And can you, by the way, explain how that will work in the first place?
So basically, the way that portfolio rebalancing is sort of thought to work is that, by purchasing, lots of, U.S. Treasury securities, and crediting the banking system with more reserves, basically banks still need things to invest in. And so as a result, maybe they're happy earning, whatever the interest on reserves rate is, or maybe they want to earn like a little bit of extra yield on top of that. So they go out and they go buy other assets. So, if you think of like the sort of like the capital asset, pricing model, the sort of the trade off of like risk versus return, like you have like U.S. Treasuries, like sort of, in the lower like left hand corner, like, and then you go a little bit further out, and then you have something like corporate credit, and then you go a little bit further out, and you have things like equities. And so basically, banks will start, I guess, according to their risk and return, mandates, will decide to buy different types of assets that satisfy their risk and return thresholds. And so, maybe they'll start with U.S. Treasuries, and by purchasing those U.S. Treasuries, they will bring the risk-free rate down, which will sort of essentially make U.S. Treasuries less attractive relative to other assets. And so then they'll creep into corporate credit, and then, eventually creep into equities. And so basically, this is the channel through which it is thought that the quantitative easing can lead to an increase in the general level of asset prices by basically buying up risk-free assets and therefore making them less attractive relative to other assets, essentially, sort of forcing investors into riskier assets. Then the way that is thought to bleed into the real economy is through something called the wealth effect. And basically, the wealth effect is this idea that consumers, when their 401ks or their retirement plans or their housing price values increase, they feel more comfortable. And when they feel more comfortable, they will tend to spend more money. And so, by this sort of derivative, like sort of indirect effect, it is thought that consumers have a higher propensity to spend when their retirement portfolios, when their asset prices are doing very well. However, there are some caveats. One, this is sort of a very indirect method of trying to target the level of spending in the real economy. And two, I think there's a lot of sort of very ambiguous evidence that's come out. If you look at stuff that comes from central banks, they'll say that quantitative easing is very effective at driving, and wealth effects are very strong. If you look at research from some other places, they find more ambiguous effects, ambiguous results from this purported wealth effect. And I think a lot of that's due to essentially consumers it's something called the permanent income hypothesis, where basically consumers will look through temporary deviations in their net worth as a result of like fluctuations in asset price levels. So if something is seen as a non-permanent change in the level of their total wealth, then consumers might not necessarily adjust their spending in proportion to it.
Yeah. So by flooding the system with more excess reserves, banks are somehow encouraged to go down the risk curve, as you said before. So they buy more riskier assets, perhaps, and then that leads into credit compression, volatility compression, all of that. That seems to be quite proven, or anyway logical. It's much more difficult than second and third round effects, and difficult to measure to understand whether the wealth effect, so the direct real economy effect of QE, can actually be measured in a very close way. Now, the last part of this interview, and there is so much more we should talk about this, but I'll invite you back to discuss about this topic in more details. For now, let's just try and scrap the surface of repo. So in your beautiful iceberg diagram there, I can see there are basically, the two forms of money we talked about, reserves and bank deposits. And then under the iceberg becomes pretty big under the water level, with something that you say collateral, and then ultimately rehypothecated collateral, which I guess happens with repo. So can you help us understand why did you put it below the water level, and what do you mean with pristine collateral and then rehypothecated collateral?
Yeah, sure. So I guess, looking at this sort of diagram here, you can see, reserves are at the top with like the monetary base. And, so those are, transferred using large value payment systems like Fedwire and chips. And sort of the reason why I decided to sort of segregate this into the sort of upper level and lower level is everybody knows about bank reserves, right? Everybody talks about quantitative easing, and bank deposits are, sort of intimately familiar to basically everybody who might be listening to this. Collateral, on the other hand, is something that is not as well understood, especially I think by people who maybe don't work with this as intimately in the financial system. It's becoming more and more well known and more popular, but I think generally speaking, it's still not very well understood by the general public, I would say. And so basically, this is a very interesting discussion. Zoltan Posar has done like a lot of great work about sort of this, and he basically calls this I believe he calls it the Triffin dilemma of the U.S. banking system. And so basically what he says is that as a result of FDIC insurance limits on commercial bank deposits, which will only go up to about $250,000 or so, to institutional investors, who might have millions or billions of dollars in bank deposits, that risk that a commercial bank might fail, and the FDIC would not be able to reimburse that investor is unacceptable for them to take for some of these people. And so basically what they do instead is they will hold US treasuries. And oftentimes it'll be treasury bills so they can take less duration risk, but some of them might be comfortable holding coupons depending on their mandate. And so for a lot of these institutional investors and these sort of large participants in the financial system, US treasury securities are essentially sort of cash in some way. And that is what we refer to as collateral. And within collateral, as you alluded to earlier, there's broadly speaking two different major categories of collateral, and that is pristine collateral, or what I've labeled here as C1, and non-pristine collateral, and what I've labeled here as C2. And so I sort of borrowed this classification framework from this guy named Manmohan Singh. He works at the IMF. He's done like a lot of really great work on collateral if you want to read his stuff. And so basically the difference between pristine collateral and non-pristine collateral is that pristine collateral has no credit risk. So those would be things like primarily U.S. treasuries, but also to some extent, you can argue that agency mortgage-backed securities are also kind of like pristine collateral because they're implicitly backed by the U.S. government. Non-pristine collateral, on the other hand, they're basically private label securities. And so basically non-pristine collateral is labeled as such because at different times and different points in the market cycle, different types of non-pristine collateral have different levels of acceptability. And so, this is maybe like a longer discussion. I don't know how much you want to get into this, but at various points in sort of market history, there, different types of assets like CDOs, CLOs, private label asset-backed securities, peripheral sovereign bonds, like, bonds from Spain, Portugal, Italy, Greece, have been acceptable as collateral in this sort of system. But, during other parts of the market cycle, participants reject those. And basically the way that this is controlled is through something called haircuts. And so basically essentially what a haircut is I guess we don't have to get like too deep into the weeds right now, but the most important thing to know is that a lower percentage haircut essentially means that a given security has less credit risk or less liquidity risk. And so basically US Treasury securities, you might be able to repo with like a 1 or 2% haircut, where something like a private label asset-backed security will, maybe repo at like 20% if you can even get someone to do a repo with you. Then we have rehypothecated collateral. And so this is something that, is really sort of down the rabbit hole, I guess, like, so to speak. And basically, rehypothecated collateral is due to this strange phenomena that when you repo a given security, you might be pledging it with rights to reuse. And so what that might mean is that, like, let's say you're a hedge fund and you have like JP Morgan as your prime broker, and you want to like lever up on say like a treasury security. So this is very common for like relative value, like hedge funds, for example, who trade U.S. Treasury securities. What they might do is they might have some certain quantity of treasury securities, and they might pledge those securities to JP Morgan, their prime broker, basically to allow JP Morgan to give them more leverage to purchase more securities. And the hedge fund will pledge these securities with rights to reuse to JP Morgan. And what that means is JP Morgan can then go use those securities and repledge those securities in a repo, or transfer those securities and use them to settle outstanding balances on, for example, OTC derivatives contracts, basically however they see fit. And so this rehypothecated collateral is controlled by this measure that you might call velocity. And so it's kind of a very abstract way of understanding this, but it's kind of analogous to the velocity of money in the real economy. And so this, that's why I put rehypothecated collateral at the bottom, because, it's something that is, very poorly understood and not often talked about, but is, very integrally important to the functioning of the financial system.
Very true. So the main message here is that if an asset manager or a pension fund has to own a lot of bank deposits overnight, they normally are very reluctant to do so because after FDIC insurance or in Europe, anything above 100,000 euro is uninsured by the government, which means you're literally running credit risk, even only overnight, but still credit risk on your banking system. Wherever you're depositing money, millions, billions sometimes of these bank deposits into a bunch of commercial banks, and you are not getting rewarded for it. So most of these pension funds or asset managers will try and engage in transactions, either reverse repo transactions where they lend the bank deposits and get back some proper collateral, which is for them a form of money. As Maroon said, it's the closest proxy to money they can get, because a bank deposit is money for them, a form of money, but it's a pretty bad one. It doesn't yield much and it brings credit risk. So why don't we move to try and get our hands on a bill, which is very close as a form of money to a bank deposit from that perspective, but it doesn't have inherent credit risk because it's issued by the government itself. And so all of this then gets into repos and reverse repo and all of this rabbit hole that maybe next time, Maroon, we're going to get yourself into, and the listeners as well. But for now, I want people to know where they can find you, because you have an amazing newsletter and a great Twitter feed. So go out and tell us where to find more about that.
Yeah, so I'm on Twitter at Maroon_Macro. So that's like my Twitter handle. And I also write a Substack called Monetary Mechanics. So I have a link to my Substack on my Twitter profile. So if you want to find me, I guess those are the two best places to find me.
Yeah, I'll put as well the link to your Twitter and to your Substack in the video description here. I mean, Maroon newsletter is one of the few that I read every single time religiously. Fantastic insights. Go and follow him up. I like monetary topics, as you know. I write about those on the Macro Compass too a lot of times. Maroon, has been a pleasure to have you here, and we'll for sure have you back in probably a month or two to discuss the repo market, if you don't mind.
Sounds fantastic. I would love to.
All right, great, guys. And if you want to listen to that interview, just make sure you subscribe to the Blockers Macro channel so you don't miss it. It's been a pleasure to have you again, and talk soon.
Thank you very much. I'll talk to you soon.